Hello and welcome back, dear students. So this is my third video on accounting concepts. So finally today we are going to start about the accounting concepts. So previous two videos were about the basic knowledge, the definition and the general information. So what was accounting concepts? So I'm expecting that you all are clear that what is accounting concepts. So finally today I'll start the different accounting concepts. So basically there are three concepts given in your textbook. So I'm not going to disclose all, so not three, sorry, six. So there are six accounting concepts given in your textbook. So I'm not going to disclose all in front of you today. In this video, we'll just start the first one, the first concept given in your textbook, that is consistency concept. Okay, concept or concept, it's up to you what you want to say. So the first is consistency. So before I will explain or before we'll discuss the consistency concept, we'll just focus on this word consistency, because see, I want you all to understand first what is consistency. If you're going to understand what is consistency, then of course you're going to easily understand the accounting concept, the accounting concept of consistency. So this is the first concept given. Okay, so what is consistency? So we'll see what are the similar words or how can we define the word consistency. So the similar word for consistency is to be persistent, to be even, or to be uniform, basically the same, like it has to be the same. Okay, so by the term itself you can understand what this accounting concept is going to tell you, that all the things, see, before I will tell you the definition, I'm telling in advance only that what this concept is saying, that it has to be uniform everywhere, or it has to be same everywhere, or it has to be persistent everywhere. So consistent, it has to be consistent. So we'll see what this concept is telling you, or what the consistency accounting concept is. So one of the basic principle of accounting states that there should be consistency in accounting methods. Okay, so I will of course give you so many examples on this one, but before I'll give you the examples, or I'll give you more examples. We'll just understand, we'll just see how to define consistency and what is consistency accounting concept. So what it states, that this is one of the basic principle of accounting, that states that there should be consistency in accounting methods. Okay, this is first point of view. Okay, these are the different ways, or for you people to understand what is accounting consistency concept. I wrote four different definitions, or four different sentences to define consistency concept. Okay, so second way to define this is, similar items are treated in same way. Okay, not only in one period but in all subsequent periods. Okay, so similar items are treated. As I said earlier, that I'll be giving so many examples on this one, but here to define this particular thing, or to define this definition, I want to give one simple example. For example, similar items are treated in the same way, not only in one period but in all subsequent period. So what this means, that similar items, which are these similar items, what it means, this word similar items. So what, depreciation, for example, depreciation. So if you are taking at one place the straight line method depreciation, okay, in one period, okay, in one period, so you have to take in subsequent period, because see, the financial statements, we can compare with 2 years, like for example this year and last, every time we are comparing, to decide something important, we are comparing the two statements. So for that, what if in one year we are going to use the straight line method, and in another year there will be reducing balance method. So of course the answer will be different in two statement. That's why it this concept is most important, consistency concept, that it has to be consistent, uniform and same everywhere. If you are taking one thing in this year, okay, in all subsequent periods it has to be same. Then the third one is, so this one was first, second, and now the third one is, it states that where a business has adopted a method for the accounting treatment of an item, it should treat all similar items in the same way when preparing the financial statements. So second and third are almost same. The same thing is said here. Like it is said here that in for some similar items are treated in the same way, not only in one period but in all subsequent period. And this is also, this definition is also is almost the same thing, that it states that when a business has adopted a method for the accounting treatment of an item, it should be treat all similar items in the same way. Okay, so these two things I will define in brief with example. Now we'll just see the last definition, that this concept prescribes use of same accounting method over time so that financial statements are comparable across period. The same thing what I said here, as I said that financial statements are comparable, like with one year financial reports they are comparing with another year, how much was the profit in previous year, how much is the profit this year. So what if we are not consistent, or we are not consistent in the accounting concept? One year we are taking this different method, and another year we are taking different method. So it's not a healthy practice, it's not good, and it's not even logical thing, because of course your the figures coming from one year will be different if you are going to adopt the different methods in the next year. If there is no consistency in accounting methods adopted to prepare financial reports, then the profits calculated would be misleading and financial analysis would be inaccurate. So this is most important thing here, that you cannot change every the methods and the standards each and every year. If you're not consistent, and if your consistency concept is not clear in your financial statement, then the profit calculated would be misleading and financial analysis will be inaccurate. So I hope this consistency concept is clear with all of you. Now I'll give you examples on this one. You can refer all, you can make notes of all these definitions. Okay, as a you can write somewhere in, if you don't want to refer the full textbook, already the explanation is given in the textbook. Okay, I tried my best to make it more simple for you, and I wrote all these definitions for you all. So now I'll give you examples, different examples on the consistency concept. Okay, so now we'll discuss the examples. I hope the accounting concept, consistency accounting concept, the definition is clear. So we'll see the first example. Okay, so for inventory valuation, I hope inventory, what is inventory, you all are aware. If not, I'll just quickly define inventory. So the inventory is the value or quantity of raw materials, components and finished products that a business has. Okay, so we all are aware that year end we are calculating the inventory, which is also known as stock. Okay, so closing inventory or closing stock. So if for inventory valuation, okay, method adopted in year one is FIFO or FIFO, whatever you want to pronounce you can. So basically the FIFO or FIFO is known as first in first out. Okay, and another method for inventory valuation is LIFO, that is LIFO or LIFO, last in first out. So if in year 1, okay, the method adopted by the company is FIFO or FIFO, then it has to be same in year 2 and year 3 and so on. They cannot change the method in year 2. If they are going to do, then they will mix two methods, okay, and then the income statement will be inappropriate, okay. So they cannot mix FIFO or FIFO in year 1 and in year 2 LIFO method, okay. So it has to be consistent. So I hope this thing is clear. See, I wrote in one line, to make it more simple for you. So we can see that there is a consistency here. It is consistent in year 1, year 2 and year 3. Basically it is uniform or same in all 3 years. If we cannot take this method here in year 2 or year 3, we have to go through the same. We have to choose all the methods in a uniform way. It has to be consistency or consistency concept or consistent in all year. Another example, okay, I think I already discussed this depreciation, but now in detail I'll explain that. The another example is depreciation calculation. See, if we are taking, okay, in year 1 straight line method for the calculation of delivery van, okay, we are calculating, we all are aware, you all are accounting students, you all are aware that we are calculating depreciation on assets each year, and there are, I think, 3 or 4 depreciation methods or more than that, but the most commonly used are straight line, and the another one is reducing balance method. So if we are taking or we are adopting in year 1 the straight line method for the depreciation calculation, then it has to be consistent in second year, and it has to be consistent or uniform or same in all 3 years. We cannot adopt in between, or in year 2 the reducing balance method, or in year 3 reducing balance method, or basically we cannot mix two. If it is straight line, then it has to be straight line. It has to be straight line in all 3 years or so on. But if we are choosing here reducing balance method, then year 2 will be reducing balance method and year 3 will be reducing balance method. If we are not consistent in choosing our accounting methods, our accounting practice, our accounting standard, then what is going to happen, as I said earlier, that to prepare the financial financial reports, if you are not consistent, then the profits calculated would be misleading and financial analysis will be inaccurate. So I hope you all are clear with this concept, consistency, why consistency concept is this much important for accounting practice. Now I'm sure that you have one question in your mind, that what if an organization or a company or a firm, they are choosing one method in year 1 FIFO or FIFO and year 2 the same, but what if they want to change this in year 3? Can we change or no? For example, I'll give you example. Yes, we can. So the answer is yes, 100%. So what is the method? How can we change? I mean, what if you want to take another method in year 2 or year 3? How can we change? So if a business chooses to depreciate, I'll just take the example of depreciation, okay? Chooses to depreciate a non-current asset using the straight line method, it must continue to use this method for useful life of the asset. However, this does not mean that the business must always use a particular method. The business may make changes if it has good reason to do so. Each change must be declared in the notes accompanying the financial statement. This allows stakeholders such as owners, managers, and suppliers to know that the accounts over the previous year are consistent and reliable, so they can make accurate judgments and decisions. So I hope so you all got your answers, whether we can change the method or no, and what are the conditions to change the method, and why consistency is this much important. So I tried my best to explain the consistency concept, okay, the accounting concept of consistency. So if you have any doubt, if you have any question, or if you want anything more on this topic, just let me know in the comment section. See you in the next video. Thanks for watching the video with the new accounting concept, that is prudence accounting concept. So see you in the next video. Bye bye, till then take care. See you in the next video.